I'm Darius McDermott from Fund Caliber, and today I'm delighted to be joined by George Curtis, who is one of the co-managers on the 24 Dynamic Bond Fund. George, good morning.
Morning, Darius.
So I think it would, with any fixed income discussion, we need to talk about rates. I'm sure interest rate movements are a big part of your overall thinking with respect to each individual bond, but also at a portfolio level. So central banks, what are we expecting from the major central banks, and what are you sort of thinking about with respect to the duration on the fund?
Yeah, so good question. Very high level, we think, across the developed market, central banks, the ECB are done. I think they're comfortable at the 2% level. But we think probably the Bank of England and the Fed will likely cut a few times. We expect that cutting path to be pretty slow and pretty cautious, mainly because the balance of risks become more two-sided as they approach neutral, which is this level of interest that neither stimulates or constrains the economy. Ultimately, the market is largely pricing in the cuts that we are expecting. So we don't really expect a large rally in duration outside a more material slowdown in growth. We have rates exposure, both for the liquidity it provides and for the protection, on that downside scenario if we were to have a recession. But we are not a super long duration, roughly 4 years in the fund at the moment, which is down from about 4.5 at the beginning of Q4 last year.
Okay. So what parts of the market are you finding most compelling? I mean, again, the other part of fixed income, really, the narrative for the last, whatever it is, 12, 18 months, are that spread, the bit that you get paid over the government bond for taking that credit risk, has been quite tight. So are there sectors where that spread is attractive, or is it more country-based, or where are you seeing that opportunity today?
Yeah, so top down, I think credit in general still offers attractive risk reward, relative to rates and relative to other markets. You've got strong corporate fundamentals, you've got high all-in yields, which give you good downside protection, and you've got low volatility. But as you rightly point out, given the spread environment, we think you have to be highly selective. I think within credit, one of the key things for credit investors this year will be missing any credit accidents. So we've not been tempted to stray too far down the quality spectrum in order to pick up incremental yield. Our favored sectors are ones in which we can pick up attractive value and couple that with strong fundamental groundings. We like structured credit, particularly on the CLO side and across the capital structure, from AAA CLOs and even double B CLOs, where we can get strong structural protection, very decent spread pickup relative to the kind of underlying corporate market in a floating rate product, so it doesn't have that volatility of rates. We also like financials, where we've seen a wave of upgrades in recent years as central banks have left negative rates. Bank balance sheets in Europe are really in the best place that they have ever been. So we like financials both on the bank and the insurance side. And I suppose areas that we are more cautious on are probably high yield, which is towards the bottom end of our exposure over the last 10 years, and in particular lower quality high yield, single B minus, triple C rated credit, which is basically a 0% allocation in the fund.
And I think we sort of touched on it because you said about that higher yield giving that downside protection. The yield on the fund's approximately 6%. And you mentioned the smaller allocation to high yield. Where are you managing to get that sort of total yield from?
Yeah, so just over 80% of the portfolio is in credit. Just under 20% is in rates. We are diversified across the credit sectors, but we are most exposed to those sectors that I just mentioned. So our favored longs are in subordinated financials, both in banks and insurance. and CLOs, and again stress across the capital structure. So we like AAA CLOs and we like BB CLOs. It's worth saying that 6% sterling yield is coming, alongside an average rating of BBB plus, which is the highest rating the fund has ever had.
So better on quality and still a decent yield, and quite a diversified yield by the sounds of it as well.
Exactly.
So the other question which you have to talk about when we're talking about fixed income, of course, is inflation. So alongside growth, inflation is the other thing that central bankers look at when thinking about rates. But it's been we're in an odd geopolitical time, aren't we? There's a lot going on from the US, but obviously across the globe. What's the inflation picture? It's been a bit sticky. I mean, when we were talking about transitory 3 and 4 years ago, well, it's more than past that juncture. Are you confident on inflation behaving in developed markets so that those rates that you talked about, particularly in the US, UK, rate cuts might continue?
Yeah, so I think it goes back to the point I made earlier about the balance of risk becoming much more two-sided. The more the central banks cut, for much of the past few months, particularly in the US, the conversation really has been around labor markets. We've seen weakened non-farm payroll growth. We've seen the unemployment rate tick up a bit. But it's worth saying that inflation is still above target, quite meaningfully so, particularly in the UK. There are trends that are positive, right? On the services side, in the US, in housing, inflation has improved quite markedly, and the expected inflation from tariffs is not really coming through in the numbers at the moment. So I think that has acted as a bit of a tailwind for duration and for the market pricing rates. And I think the central banks are happy to be seeing that. But I think certainly, like we have seen in the last couple of years, we're going to go through periods where inflation is maybe printing slightly stronger than expected, and I think we're still going to get volatility in the market's pricing of cuts during those periods. So I don't think the inflation bogey has disappeared. And I think it will still remain front of mind for central bankers. But there are some dynamics within inflation that have, I think, certainly been positive over the past 6 to 12 months.
And you touched briefly on tariffs, and God knows we all talk too much about tariffs in 2025, but is there a lagging effect, do you think, for that inflation? I mean, again, if you just put into Google what the tariffs mean, well, I think inflation was one of the answers that came up. Yet, do you think that's going to be a lagging effect into 26 or slightly overplayed?
I think it could be, yeah. I don't think the market should get too optimistic on inflation. I know we've had a couple of good prints over the past months, both in the UK and the US. But I think part of the lack of reaction in inflation that we've seen, from tariffs might just be because producers, corporates have taken some of that margin hit, and have taken that margin hit whilst labor dynamics have been weakening. So maybe in 2026, if growth is solid, which it's expected to be, and maybe jobs growth improves a bit, maybe corporates start to push a bit more of that price onto the consumers. So I definitely think that's a dynamic that is possible. I would say that we've been surprised by the lack of impact so far, and there have been articles and actually studies one by the San Francisco Fed recently, which have alluded to the fact that maybe the inflation pressure from tariff will be lower than people were expecting.
And maybe then, as a sort of a last question, would you tell us about the top 3 themes for the rest of 2026 for the TwentyFour Dynamic Bond Fund?
Yeah, so I'll talk about the three themes from a fixed income perspective, and then how we are managing that within Dynamic. I think the themes are probably similar ones to 2025, right? I think the market's been quite focused on AI, has been focused on private credit, and has been focused on the fiscal side of things. We've seen obviously lots of volatility in the longer end of government bond curves. With respect to AI, we've had and will continue to see a large amount of issuance from the hyperscalers, but also from other issuers. And we've seen pretty lofty valuations in equity markets, with a lot of optimism that maybe it doesn't play out. So, if credit markets struggle to take down that enormous amount of issuance, or if equity market valuations re-rate lower because the return on investment from this AI capex is maybe lower than people expect, there could be contagion. On the fiscal side, government spending is too high, and I think maybe that's become less of a focus in recent months, given other dynamics, labor markets and inflation. But that, I think, will continue to periodically pop up in the coming years. We're not expecting a 22 type sell-off in the gilt market, for example, but the net amount being issued to the markets on the government bond side is large, right? 2 trillion plus in the US. And the way that this is manifested, and we think will continue to manifest, is by seeing higher risk premium, building a higher term premium into government bond curves, and we can still, I think, expect volatility, particularly at the longer end. And on the private credit side, it's obviously a sector that has grown very quickly in recent years, and maybe there have been some concerns emerging about the quality of the underwriting. I think in some areas, not this is only related to, I think, a few areas. Particularly after Tricolor and First Brands and Jamie Dimon's comment about cockroaches in the space. So, in truth, we are likely to see more, quote unquote, cockroaches. This is the nature of, high yield credit investing. You can expect default rates to be, more than zero. The historical average in the US high yield market, for example, is above 3%. I think the thing that will most acutely affect that default rate in the private market will be what happens to the economy, right? And I think that default rate in private market will ultimately be quite correlated to the default rate in the public market. Yeah. So from our perspective, Dynamic has no direct exposure, to AI. It's obviously got no direct exposure to private credit. We don't have an investment where the return on that investment will be determined by the return on equity on AI capex. Yeah. We are not exposed to the vagaries of the long end of the government bond curve. We don't have any 30-year exposure in any currency, and of course we focus on liquid, public credit, and we do have a lot of liquidity, and we have flexibility. So I think in this environment in particular, maintaining that flexibility, maintaining that liquidity, focus on strong, rigorous due diligence from a bottom-up perspective, and you're very well placed to take advantage of any credit volatility if we were to see it.
George, thank you very much. And if you would like to get more information on the TwentyFour Dynamic Bond Fund, please do visit fundcaliber.com.